For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about the top 10 questions that we get here at Floyd Financial Group as far as getting into retirement. We'll also have some answers for you. My name's Jeff Shade, and as always, I'm just here to ask the questions, but of course, the words of wisdom and solid advice, they come from Randy and Jake Floyd at Floyd Financial Group right here in Springfield, Missouri. First off, Randy, how you doing today?
Doing very well, Jeff. How about you?
I'm doing fantastic. And Jake, good to hear your voice, see you. How are you today?
I'm doing great, Jeff. Thanks for asking.
You're certainly welcome, my friend. I hope everybody is having a great middle third month of March here. Boy, things are changing in the world out there, and things are changing weather-wise. And, you know, I'm really, really happy that the flowers are beginning to poke their heads out of the ground a little bit. We're getting a little more of this warm weather, and it just could not come sooner as far as I'm concerned. We get a lot of questions here at Floyd Financial Group, and we love to have people ask us questions because that's what we're here for. So on today's show, we're going to be talking about the top 10 questions that we get here at Floyd Financial Group. And the first one is going to be about Social Security. Primarily, it's going to be when to take that, but also people want to know, is it going to run out? Are my checks going to be delayed? Are they going to end? So what do you want people to know about Social Security today, Randy and Jake?
Yeah, so we need to talk about some real basics. When it comes to retirement and people get close to that age or they're thinking about pulling that trigger, they have to go, I wonder how much my Social Security benefit will be. It's one of the questions that comes up. And also, many times it's a determining factor as to whether or not people can actually retire. So what I want to kind of cover some bullet points on here today is people coming to me and say, so Randy, when should I take Social Security? That's probably the number one question about Social Security that we get. Now, there is concern right now out there, as you alluded to, Jeff, that is money going to run out in Social Security? Is it going to go bankrupt? Are we going to let it do that? And the answer to that question is no, they're not going to let it go bankrupt. It's not politically very popular to talk about Social Security in any context except how good it's going to be. So the long and the short of it is they're going to keep it propped up. They're going to figure out how to keep it running. But I will say there may be some changes. If you're probably 55 and younger, there may be some changes as to when and how much Social Security you will get. And there may be some bigger changes than that down the way. But right now we want to talk about this age-old question. Randy, should I take Social Security at 62? Or should I take it at 65 when I become Medicare eligible? Or should I wait until 70 so I can get the maximum benefit out of that? So I always tell people here, Jeff, there's really two sides to people, and especially when it comes to retirement. One is there's the financial and the practical side of things. Well, if I want to take Social Security, shouldn't I wait and get the maximum benefit? That's one question that we get. And the other one is, well, I'm a little concerned that it might not be here, and I'm not sure how my health is going to hold up, so shouldn't I start at 62? There's the emotional side of things, and there's the financial or the hard fact side of things. Mm-hmm. And we often tell people here, and Jake will probably mirror this, that, if we knew the exact day you were going to pass away, then we could tell you the exact day to start your Social Security. But since we don't know those numbers, we have to look at it on an individual basis. And really what we do here is drill down and ask a lot of questions about health, how people feel, if they're just sick and tired of being sick and tired, if their body has worn out and they can't work anymore. Maybe it's a combination thereof, but everybody's situation is a little bit different.
Right, and it seems to be pretty simple. 62, you're going to take it early, but you're going to have an earnings cap on that. You can't make as much as you want if you are working. Full retirement age, I think for most people listening to us today, Randy, is going to be 67. Then you have age 70, but there is quite a gap in the amount of money that you will eventually get if you take it at 70 versus 62. It really is a big question. There's this break-even age that I hear talked about all the time. What is the break-even age?
So the break-even age is, let's say we start taking Social Security benefits at age 62.
Right.
And just for ease of figuring here, let's say that my benefit is $2,000 a month at age 62. Well, if I wait and don't take that $2,000 a month payment each year, it's $24,000 that I have given up. So as I look at how much more my payments are going to be by waiting, I take the difference in the monthly payment at the different ages and divide it into the income that I gave up to get the number of months that it takes me to break even. So many times when we show this to people, they go, wow, that's a long time. So if I wait till age 70, I got to live to 88 or 89 to get even. And many times that is the case because they gave up all the income along the way. Now, everybody needs to take time, and we help people do this, to really do their calculations for themselves and really see what that means to them. Granted, if you wait till 67
Right.
And take it at full retirement age, that's great. And you can make all the money you want to after that if you want to still maintain and work a job or have some type of a side hustle out there. But you're going to get 8% simple on top of that for those last 3 years. So it makes a lot of difference if your benefits, say $2,000 a month at age 67, it's going to be another 8% on top of that. On that 2,000 is 160 plus 160 plus 160 gives you $480 a month more by just waiting those last 3 years. But is it practical to wait? And that's the age-old question that everybody has to deal with. And the other one that comes up a lot of times is, hey, what about spousal benefits? How do those work? One of the questions that women have for me a lot of times is, my husband's 5 years older than me. He's not in the best health. What happens to his Social Security check when he passes away? The answer generally is the larger of the two checks, whether it's the wife that survived the husband or the husband's check, is going to be the one that remains. So that kind of comes into play when people are getting along in years and they're trying to figure out end of life and how that last spouse is going to survive in the event one dies early.
Right, and as you said, it's how long you're going to live that will probably determine when you should take Social Security. We don't know that. Now, I have taken one of these calculators online, and it asks me a bunch of questions. It says that I'll probably live to around 86 years of age, but again, that's just a big guess. So Social Security, one of the biggest questions that we try to answer here at Floyd Financial Group. Again, if you've got questions about Social Security, I'll give the phone number out right now so you can call up and make an appointment to come in, talk to us about that. 417-889-7233, 417-889-7233. 10 questions we're answering here today in the radio program. Next one is, I've got a pension and they're offering me a choice. I can take it as a lump sum or I can take it as a monthly annuity. How do we figure that one out?
Yeah, this is another big question. There aren't that many people that have pensions anymore. I think the last number I heard was somewhere around 16% of people still have pension payments that can come out. So I know we're hitting kind of a small target audience here, but this is pretty important because when we look at the option to take a lump sum or to take payments, it comes back to this age-old question that we've asked on here many times, Jeff, and that is, would you rather have $1 million or would you rather have $50,000 guaranteed for life? And so that question sounds very daunting in the beginning, except when you boil it down, if I can earn just a 5% return on my $1 million, I get my $50,000. And guess what? I still have my $1 million lump sum.
Right.
Versus if I take the pension, I give up my $1 million lump sum. Now, granted, you can set it up and take a reduced amount and let it survive you and go to your spouse, those guaranteed payments. You can do that. But I got to tell you, historically, if you really were to look at it, it makes more sense most times. Now, not always. There are people that just say, you know what? I'm going to be nail biting every night. I won't have any hands left in a few years. I need to have that guarantee of income that's going to come in. And there's other ways to contractually guarantee that income as well. So something that everybody needs to think about, again, do I want the lump sum or do I want that guaranteed payment? There's no right answer here. Again, it comes back to there's the financial sense of it. If you look back over history, you would say probably don't want to take the pension payment. I want to take the lump sum. But again, everybody's situation is a little different and they're how they feel. Remember the lady that said to me, hey, we got to talk about scary money stuff. Some people that just want to take all the scary out of it.
I think sometimes too, Jeff, there are times where it makes sense to take the monthly income but it needs to be a pretty big number as a percentage of whatever that lump sum is. So like Randy said, if it's $1 million or 50,000 a year, that's an obvious choice. But what if it's 80,000 a year on $1 million? What if it's 90? What if it's 100, right? At some point, it makes more sense to take the income. And again, there's a lot of considerations there. So this is certainly not blanket advice, but sometimes if the monthly benefit is big enough, what we'll do is we'll take the monthly benefit and buy a life insurance policy on the person taking the income who has the pension to protect the spouse in case he passes away early. You don't want to lose all that money, right? So there's a lot of creative strategies out there, but again, there's no blanket answer. A lot of cases, it can make sense to take a lump sum. Like Randy said, it kind of depends on interest rates at the time. It depends on a lot of factors, but that's one of the things we spend a lot of time talking about in the office here.
Talking with Randy and Jake Floyd, Floyd Financial Group. We're talking about the top 10 questions that we get here at the firm. We talked about Social Security, pension versus a lump sum. Next one is big one. How much income am I going to need in retirement to keep the wolf away from the door? How do you make that calculation or answer that question?
Right. So I think the real question here is people are going to sometimes say, well, how much income will I have in retirement? So the first thing, of course, is we got to look at what Social Security is. I think for most people in this country today, Social Security will end up being somewhere, I say most, the vast majority, between 35 and 40% of their retirement income. In some cases, it will be higher than that. And then we're going to have investment incomes. And again, if they're one of those 16% that happens to have a pension, those are going to be the three main sources of income. Social Securities, their investments in their 401ks, their IRAs, their 457 plans, all those different things that they can roll over and start to take income from. The gross amount of income that you're going to have in retirement is much different than the gross amount of income you're going to have while working. The tax amounts change. So when you sit back and you say, hey, I'm making $150,000 a year at my job, or both of us are, my husband and wife together are making $150,000, it may really only take $100,000 or $110,000 to actually equal the same amount of take-home money that they are having right now at $150,000. And you say, well, how's that possible? Well, number one, you're not going to pay Social Security tax, Medicare, Medicaid tax anymore once you retire. Also, you may be funding your 401k or your IRA to the tune of $10,000, $15,000, $20,000 a year. I don't know what that number is. I have some people that are funding those things at $30,000 a year when they come in to see us because they're just wrapping up. They paid off their house. They paid off all their student loans. They paid off their kids' student loans, all those sorts of things. And so they're racking up and saving a lot of money at that point in time. So when we really boil it down and we look at, okay, what's the budget and what have we been bringing in? What's the bottom line that's been coming in? When we look at all those things and compare them, sometimes the numbers are much different than people think. So we just want to be sure that we've looked at how much income we really need. We also need to look at what are your taxes now versus what are your taxes going to be, like I alluded to, in retirement. And also, what assets do I pull money from first? Do I pull money? I had this situation come up just recently where they don't want to take Social Security until age 70. And they're pulling income out of their IRAs and their 401ks now, waiting for that bigger check. And their situation is such that, so what if you don't make it to 70? What does that do to you? Well, if you don't make it to 70, doesn't really matter, right? But if you do, they're going to have the larger payment, and then they can slow down money coming out of their IRAs and 401ks to a point, because the required minimum distribution you need at age 73 is only around 4.25% that first year and ticks up over time. So you can really scale it back and let your Social Security grow. That's one strategy. And I would say in those situations, that's going to be for people that feel really optimistic about the future. They're in pretty good health and they're just looking to maximize income. And also the one thing to consider is taxability on Social Security is only up to 85% of what you collect. Not that it's an 85% tax, but in other words, rather than being taxed on $1, you're going to be taxed on 85 cents as a maximum. And it could be that your Social Security tax would be zero depending on what your income is.
These are the top 10 questions that we get here at Floyd Financial Group. We're answering them for you today on the radio program. We talked about Social Security, pensions versus the lump sum, also how much income you'll need in retirement. If our conversation has piqued your interest, you want to get in and sit down with Randy or Jake at Floyd Financial Group and ask these questions in person, you can do that by scheduling your no-cost, no-obligation, no-judgment Floyd Financial Group review. Just a casual conversation. 417-889-7233 is our telephone number. 417-889-7233. Leave your name, telephone number. Ashley will call you back during the week and set up that appointment for you. Again, it's not going to cost you a dime. There is no obligation. There is no judgment. We'll meet you where you are. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Randy and Jake, we're going to take a break. When we come back, we'll continue with our top 10 questions and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpas, Randy and Jake Floyd.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to continue on the income stream, if you will, and to answer questions on that. But the next question is, now that we've set up my income, Randy, how long will my money last?
That's exactly right. We don't want to run out of money in retirement, Randy. We've done this financial plan, but sometimes things change, and that will affect how long our money will last. So when people say, Randy, here it is, this is how much money I've got, will it last till the end of my life? How do we make that determination?
Yeah, that's a really great question, Jeff. And it's been said that something like 68% of people are more afraid of running out of money than they are of dying, right?
Oh, yeah.
So that's a really important question for people. And the thing that I will say, and this should go without saying, but I'm going to say it anyway because it sounds kind of stupid for me to say it. Well, it depends on how much money you withdraw from your investments as to how long they will last, right?
Sure.
So our goal here when we sit down with people is, unless you tell me something different, we're going to plan for your money to last until age 95.
Okay.
Now, most people don't live to age 95. We know that. Unless you're on some of the early Social Security checks and you're at 360. But anyway, sorry.
360 years.
360.
Yeah.
Oh,
so you were
man.
over here collecting Social Security before the country was founded.
Yeah, exactly.
But anyway, we set up reasonable expectations. And one of the things that happens when people come in, they sometimes say, I'm just wondering if I'm going to be able to retire here in 2 years, 3 years, 5 years, next month in some cases. They're saying, are we for sure that we're going to be able to do that? So again, we plan for money to last to age 95. We use different asset allocations depending on the client's risk tolerance and what their needs are. We know that generally speaking, there's this old rule out there that we've talked about on this show many times, the 4% rule, which basically says, hey, whatever your gross amount of retirement assets are, take 4% of those. So if it was $1 million, that's $40,000 a year you can draw. And then you can adjust that for inflation each year as inflation comes along. And you shouldn't run out of money. And that is true, provided the allocation of things is set up properly. If you went out and put all your money into speculative stuff, cryptocurrency, and some other fledgling stocks that are not strong and positioned right, you can run out of money really quickly. But what we're going to do is we're going to go out and we're going to build portfolios around solid companies and solid setups and interest rates and bonds and those sorts of things so that we know that long term, and I will tell you, we can generally set things up to where we can take a little more than that 4%, maybe in the 5% range, and probably keep your portfolio growing even through times like what we've been recently experiencing. We've had some really great years. We've had some really bad years, and that's the way it always works. If you're positioned right where you don't take too much downside when the downside is occurring, and that you can capture most of the upside when the upside is happening, long term you're going to win and you're not going to run out of money, and you're probably going to grow your balance just a little bit over time.
Talking with Randy Floyd, Floyd Financial Group, answering the age-old question, how long is my money going to last? Among other questions here on Show Me the Money. Next one that we get questions about all the time, and it is a big one here, is about taxes. I think a lot of people are mistaken that they will pay less in taxes in retirement. It's possible for people to pay more taxes in retirement, but I think historically with your clients, people do pay maybe slightly less, or am I wrong about that?
Yeah, I would say, Jeff, that as a rule, people are going to pay slightly less in taxes than they did, during their working years. In some cases, depending on the situation, it could be that it will be a lot less during that time. And a lot of that is dependent upon how your assets are set up. Do you have all traditional IRA or 401k money where none of the money's been taxed? If that's the only investments that you have, we have to look at that along with Social Security and see what kind of tax bracket that puts you in and how to set that income up for you in the best way possible. Again, do you have many options there? You really don't. If all your money is taxable, it's hard for me to mitigate taxes there. One of the things that you could do, and we'll talk more about this later in the show, is 5 or 10 years before retirement, you could look at converting some of your money to a Roth IRA. Now, you have to pay the tax right now, but down the road, you get to pull all the money out of there tax-free. You have to hold it 5 years and be older than 59 and a half and turn on the income there, and then you pay no taxes on that. However, there's some things you give up now, meaning money that you have to recoup to generate the income you might give up. So, again, we talked about this earlier. Social Security, depending on what your income level is as a married couple, if you keep it below $25,000 roughly, you're at zero tax. If you keep it below up to the $34,000 number, you're going to be at 50% of Social Security being taxable. Anything north of $44,000, you're going to pay on 85% of your Social Security payment. But again, we just have to look at all this stuff and figure out what is the most tax efficient way and where should we draw money from to keep your tax burden as low as possible.
Well, I think it's a foregone conclusion that taxes are going to go up. We have such a budget deficit at this point in time. So I think that really planning for taxes to go up is a smart thing to do. But do you think that taxes are going to stay the same? I know that a lot of people listening to the program may be in retirement, or maybe they're retiring in the next 4 years. Are we looking for a friendly tax environment while Trump is in office?
I think for most people, the average retiree, somewhere between $60,000 and probably $120,000 a year, I think your taxes at the federal level are probably going to stay pretty much the same. They may move a little bit, but it's not going to be drastic. If you get above that number and you get into the $200,000 and $300,000 and $400,000 a year bracket where you're making that kind of retirement income, you may in fact see that your taxes will go up. So it's really important for us to have a good tax strategy for those people. But everybody else, I think that it's just not in the cards for any political party to go out and drastically raise taxes.
I think some of our listeners may be hearing this and they're going, boy, I'm glad I've got my CPA handling these taxes for me. Explain why a CPA doesn't do financial planning and why a financial planner doesn't do the CPA work. They're actually two different disciplines, right?
They are two different disciplines. I will say this, though. We have seen over the years where there were CPA firms that have large client bases where they do actually do wealth management. But I think that the two are almost counterintuitive to each other. Meaning the CPA guy is trying to say, okay, how can we cut your taxes? How can we keep your taxes to a minimum? While the financial advisor, many times what he's focused on, and we try to be focused on both sides of that a little bit. Most financial advisors will never give you any tax advice. And I'm not really in the business of giving tax advice, but I understand taxes enough to help you structure things and get you in a good tax position. But I think the difference is it's kind of like the study of economics is the study of lack. Well, financial advisors are not looking at lack. We want to grow money and be making money rather than trying to figure out always how to cut costs. We want to cut costs, yes, but we also want to grow and make money. I think that's why we're a little bit sometimes, I don't know if we're diametrically opposed, but we're kind of on different sides of the fence.
Talking with Randy and Jake Floyd of Floyd Financial Group, we're answering the top 10 questions that we get here at the firm. We talked about Social Security, pensions versus a lump sum. Also, how much income am I going to need in retirement? How long is that income going to last? And of course, most recently, we've been talking about taxes. Next one is going to be investments to support that income plan. We've got a lot of options there. How do you answer that question?
Yeah, we do have a lot of options there. And here at Floyd Financial Group, we can really invest in anything. However, I will tell you that I do believe that there are certain investments that are more appropriate for people in retirement. Now, even people in retirement have a little different take on things. So yesterday I sat down with a lady, a very wealthy lady, and she recently lost her husband. And her husband was a risk taker. And she said, I am not. In fact, when I asked her one of the questions on our questionnaire that helps us to kind of determine where people sit investment-wise, one of the questions was, if the market had a recent downturn and you lost a significant amount of money, what would you do? And one of the questions is, does it hurt your feelings? Does it hurt you emotionally? Does it hurt you psychologically? And she said, absolutely. I don't want any chance of loss. Then I have the other people that sometimes come in. I had a guy come in here, this has been a while back, but he said, I don't care if you lose it all, just make me some money. Well, now, number one, we're never going to put anybody in that position.
No.
But that's kind of the gamut that we see from one side to the other. But when we sit down with people, we really want to know how they feel about money, because our job really, as an advisor in many cases, is we know that markets are going to change. We know that interest rates will go up, interest rates will go down, bonds will be in favor, out of favor, market will be in favor, out of favor. We will have periods of time where the market surges. We will have periods of decline. And our job is simply to meet people where they can stand the volatility within their portfolio and make them the most amount of money within their risk tolerance. Now, that was a mouthful, I know.
Yeah.
But that is really it, because we know this, 70% of the time the market's going to be up, but the 30% can kill you if you don't handle it right. And so that's really what we're about here, is helping people to design portfolios that keep them comfortable, keep their income coming in, and keep their balances in their retirement accounts to where they feel good about it. Another lady I had in here yesterday, she said, hey, Randy, I just want to make sure that my portfolio, even during this recent downturn, is holding its own and doing fine. And so we looked at it, and we looked back a couple of years at where she was and where we had been. And sure enough, we were hanging right in there. And so she was happy. And so we didn't make any changes to her portfolio at this point, but we did talk about what's going on and what we think the future holds. And so we had a good conversation. That's one of the keys, too, I think, to investments and allocation, is to always maintain and keep a good, open dialogue between us here at Floyd Financial Group and our investor.
Yeah, and I think women typically are more risk averse than men are. Men want to shoot the lights out. Women are like, well, let's save and protect what we have. And that certainly is understandable. And I love your stories, Randy. And for those people who have not heard this one, I want you to repeat it again about the couple that you had in there. And they were retiring, and the guy was all set because he had bought himself a motorhome. And tell that story a little bit.
Yeah, that's been a long time ago. But yeah, basically he came in, he was really excited. And so we're sitting at the table there, and he says, yeah, I got my motorhome. And he had bought a really nice one. I think it was maybe one of those, maybe an American Eagle or something, but really a nice motorhome. And he said, yeah, I got my satellite dish up on there. Of course, we don't need those anymore, but so that tells you how long it's been. But he said, I got my satellite dish up there. I can raise it up. I can put it down. But I got my laptop in there, and I can trade stocks every day. And his wife looked at me, and she said, then I'm not going with you. Is basically what she said.
The guy's in retirement, and he's focused on trading stocks. I mean, I thought you got into retirement because you wanted to relax and see the world a little bit. But no, I can understand completely what she's talking about. You take the motorhome, you go out, travel the country, do it all you want. I'm going to stay right here because I don't want anything to do with this at all. Anyway, we're talking about questions that we get here at Floyd Financial Group. And again, if you've got a question for us, you'd like to sit down and have a casual conversation with Randy or Jake here at Floyd Financial Group, we're offering it to you no cost, no obligation whatsoever. As always, our telephone number 417-889-7233. 417-889-7233. You can make that call this weekend if you want. It'll only take you about a minute or so to leave your name, telephone number. Say, Ashley, give me a call back. I'd like to set up an appointment with Randy or Jake. Ashley will do just that. And again, there is no cost for this consultation. There is absolutely no obligation, and certainly there is no judgment. We'll meet you where you are. It's just a friendly and casual conversation between you and Randy and Jake at Floyd Financial Group to get the questions answered that you need the answers to put you on a path towards a confident retirement. Again, 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Time for a break. Randy and Jake, when we come back, we'll continue down this line of questions that we get here when our show continues on 104.1 FM KSGF, where Springfield comes to talk.
Nowadays, 401ks are a part of life. Chances are you or your spouse have a current one, or even an old one that's tied to some long-forgotten job. I'm Randy Floyd of the Floyd Financial Group, here to ask you an important question about your 401k. Do you know your options, your fees, and if you're maxing out the benefits? If you want to know more about your 401k inside and out, call 877-889-PLAN for a complimentary review. That's 877-889-7526, or visit us online at floydfinancialgroup.com.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to talk about Medicare versus Medicaid, a little bit of the differences, and just what it means at age 65, too.
Yeah, and a lot of people get these things confused, Medicare and Medicaid. Now, Medicare is something that you're eligible for when you turn 65. I think everybody, if I'm not mistaken, gets Medicare. It's sort of a highly subsidized healthcare program that we have here in the United States. Doesn't pay for 100%. Medicaid is a totally different thing, or I won't say totally different, but it is different because you have to meet some certain income thresholds in order to qualify for Medicaid. But let's start with Medicare. Does everyone get Medicare when they turn 65, Randy?
So Medicare, we generally get at age 65 unless we've been disabled prior to age 65 and we're on some sort of disability. Now, I will say this too, that there are people in this country that are not eligible for Medicare, and that's because they haven't paid into the system. So a couple of things that people might find interesting is there are people that have been in this country for 20, 25 years that pay taxes that do not have a Social Security card.
Wow.
That will not get Medicare. So basically, whenever you get your Medicare card, used to be Social Security, that number was your Medicare number. Of course, years back, they changed that because of all the fraud and things that we have going on today. Mm-hmm. But Medicare basically is for things we're going to get over. It's for acute health care. So if we have something that happens to us and we need to get patched up, stitched up, cut up, or whatever it may be, something we're going to get over, is what Medicare will take care of. And there's some rehabilitative stuff on there and a little bit of long-term care, maybe up to 100 days that some of those plans will pay for. On the other side of this, and of course, Medicare, once you go on it at age 65, you pay, I think it's $180 is the new rate now, roughly something like that per month to have Medicare Part B. And then to fill the gaps in Medicare, you buy a supplement or an Advantage plan. Jeff, if you're in a situation where you don't have a lot of income, you may qualify for spend down Medicaid, and Medicaid will come in and help you with certain things like pay for medications, your regular health care each month, maybe dialysis if you have stage 4 kidney failure, that sort of thing. And then the other part of Medicaid that's out there is what we call vendor Medicaid, and vendor Medicaid is designed to pay for nursing home, something where you're going to have chronic illness or something where you need 24/7 care and you are not going to get better from it. It's one of those things where you need, again, long-term care for your health.
Now, I've heard that insurance gets a lot easier when you have Medicare, but Medicare doesn't exactly cover everything.
No, I mean, if you look at traditional Medicare, basically it leaves out, just regular physical examinations. You get one when you turn 65, but the rest, you have to you don't get another physical after that necessarily. Now, your doctor, your primary care is probably going to do that along the way for you anyway during your visits if you have an ailment of some sort. but they don't do much on vision. They don't do much on dental, also hearing. But if you get a Medicare Advantage plan, they do have many of those benefits included there. And really the difference between Medicare and a Medicare Advantage plan is basically the money that Medicare would earmark to be spent for you is given to an insurance company that runs the Medicare Advantage plan, and they're able to run it probably a little bit more efficiently, and that's why you get some additional benefits. Some of those even have healthy food allowances each month and stuff where you can buy fitness equipment and things to help you maintain your health.
Okay, so Medicare is Part A. I mean, that's what we get automatically at age 65 if we have paid into it. Part B was the supplement that you have to pay for. And as you said, currently it's around $180. You can have that deducted from your Social Security check, I would imagine. And then beyond that, there's what? Is there a Part D anymore? C, that sort of thing? And then there's a G, a Medigap plan.
Well, Part D is in dog. That's what you have to have for a drug card that attaches to a Medicare supplement program. Most of the Medicare Advantage programs have a drug card embedded with them when you sign up for that program. The Medicare Part G is actually a supplement plan. G is in George. That probably is one of the more robust programs and has a little bit extra for long-term care or for extra length rehabilitation.
So with all these choices that people have when they get Medicare, how do we help people make the right choice for them?
So we have to sit down and have a discussion about what makes the most sense. We have a gentleman that we refer most of our Medicare business to at this point. His name is Tony Gossard, and good guy. He's been doing it a long time and understands all the ins and outs of it. So that's something we can help guide and direct people to.
All right, so that's Medicare, and as you said, Medicaid. There's a spend down Medicaid. For those people just joining us again, Randy, can you repeat what spend down Medicaid is, and is there even another type of Medicaid?
Yeah, so Medicaid, spend down Medicaid is basically where you have a lot of health conditions. You're able to live at home or be at home. You don't need custodial care or 24/7 care, but you are also spending so much of your money on health care that it puts you down below the poverty level. Vendor Medicaid is for nursing home, and there's a whole different set of qualifications on that I won't get into today.
All right, so these are questions we're answering for you here at Floyd Financial Group. Our top 10 questions. In this segment, we talked about Medicare, Medicaid. Next one is something that we hear a lot about here, and that is the Roth. What is a Roth for those people who do not know? Why would we want to use one?
Yeah, so the Roth IRA, I think it came on the scene about 1997. It's been out there a long time. It took a long time for the public to get on board with some of these things, but also it was not quite as popular because it didn't give you any type of a tax break today. Whereas your traditional IRA or 401k versus a Roth IRA or a Roth 401k gives you tax benefits today, the Roth gives you benefits on the end, meaning that once I deposit money into a Roth IRA, it's been there basically 5 years, and I'm 59 and a half. I take all of my principal, of course, tax-free out of there, but I can take all my earnings out of there tax-free as well. And so it can be a way to have income coming in each month that never shows up anywhere on your tax rolls. It doesn't even produce a 1099 or any type of a record for the government at all because it's not taxable. Now, there are rules that come along with this. We alluded to a couple of them. That is, you have to leave it till 59 and a half, or number two, it has to be out there 5 years for it to qualify. Now, sometimes people say, well, I haven't funded a Roth at all. I've been funding everything into my 401k, but I would like to convert some of my traditional IRA or 401k money into a Roth IRA. So you can do that, and you can do that lump sum, and the rules of over 50 at $8,000 a year don't apply to that. But there are income limits. I won't get into all the complete detail here today, but I will say this. When you convert that money in a conversion, every conversion you do has its own 5-year clock on it. So if I do 50,000 this year, that's got a 5-year clock. If I do 50,000 next year, that's got its own 5-year clock, which will be 1 year later than the first 50 that I did, and so on. You kind of get the idea how that works. So the reasons to do a Roth conversion is, hey, down the road, I won't pay taxes on any of that money, including the growth. The problem is I have to give up the tax money today. So if I'm already out there working, I'm making $150,000 a year, and I put another $50,000 into my Roth under a conversion rule, then I'm going to have to pay the tax on that additional $50,000 today. So it does two things. Either takes money out of your hip pocket or out of the current IRA to pay those taxes. And so you start with a lower balance. If people have large amounts of money in 401ks and IRAs and they're looking to convert, I would tell them that you need to start thinking about it today rather than later. Because if we can start early enough, even maybe 10 years ahead, if it's money that you want to convert to the Roth, let's start today because we can keep you in a lower tax bracket. It'll cost you less out of your hip pocket. And long-term for growth and income, that's a good thing.
Randy, I think you may have alluded to this earlier, but can your income be too high to contribute to a Roth IRA?
Yeah, your income can be too high to do regular contributions to the IRA, but there are ways to go ahead and do that through what we call a backdoor Roth, and that's something I will not talk about on this show in detail at this point.
Okay.
I mean, it's fine to do. It's just that it's a little more complex, and we need to actually sit down with people, understand there's income limits is basically what it amounts to on doing a traditional Roth. And the backdoor is a way for people that have more income than would normally be allowed to set up a Roth to do that.
All right, we're answering questions with Randy and Jake Floyd here at Floyd Financial Group that we get every day in our office. If you've just joined us, we have talked about Social Security, pensions versus the lump sum, also how much income I'll need in retirement, how long that income is going to last. We talked about taxes a bit, investments, Medicare, Medicaid, and we have talked about Roths. If you've missed any part of the program, you want to hear this all over again, we're a podcast. Go to wherever you get your podcasts. Search for Show Me the Money with Randy and Jake Floyd. You're going to find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. And listening to the program today, you've got questions that we haven't answered for you on the air today. You can give us a call. We'd love to sit down in person and talk to you. Our telephone number, 417-889-7233. 417-889-7233 to request your casual conversation. No cost, no obligation. Leave your name, telephone number. Say, hey, Ashley, call me back. I want to talk to Randy or Jake. She'll do that during the week and set up an appointment for you. And it'll take 20, 30 minutes. As long as it takes, we will answer your questions. And again, it's not going to cost you anything. 417-889-7233. Also, check us out on the web at floydfinancialgroup.com. All right, time for a break, Randy and Jake. When we come back, we'll wrap it up by talking about long-term care and estate planning when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money. Because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about long-term care.
And Randy, you know, when you talk about long-term care, there's a very high percentage of people who will need some long-term care. I've heard some astounding statistics that say if you reach the age of 65, that, you know, it's better than 50% chance that you're going to need some sort of long-term care. And if you've ever checked out how much long-term care is, it is not inexpensive. It's not hard to spend six figures in long-term care. So let's explain that a little bit, Randy, about long-term care and some of the ways that we can suggest that people pay for that.
Yeah, Jeff. So for 15 years, I did public seminars about what's called 4 ways to pay. And that is the 4 ways to pay for long-term care. And I'm going to add one additional one today that a lady told me that she planned to implement. And it was with her husband's blessing when she told me this, because he was sitting right there with me. So long and the short of it is, the 4 ways to pay for long-term care, should you need it, is number 1, write the check out of your hip pocket each month. Right now, right here in Springfield, Missouri, right in the middle of the last bastion of sanity where we live here,
Yeah.
assisted living is somewhere between $6,000 and $8,000 a month, and full-blown nursing care is somewhere between around $7,000 and maybe as much as $9,000 for a private room per month for people to be in there. So out of the hip pocket is something that most people are just not actually able to do, at least not sustainably for a long period of time. Secondly, if you are a veteran, we want to thank you for your service. And if you are curious about the veterans benefits, there's this thing called aid and attendance that we can shed some light on and help you to direct you as to where to go to get some help on that. And what it does is it can reimburse medical costs out of pocket for home health care, assisted living, and finally nursing home. Now, it's a limited benefit and it's a Band-Aid. It's not going to be the be-all, end-all to fix things. Thirdly, you can have some type of insurance. So there's traditional long-term care insurance where basically I pick a daily benefit amount with an inflation fighter because things cost more in the future. I pay a certain amount per month to have that. Problematic with that is the fact that generally over time it prices people out of the market. Then there are other types of life insurance products that actually have a long-term care benefit on them that sometimes make more sense. And then there are savings plans, I would call these, that kind of look like life insurance and kind of look like a savings plan that allows us to access and tap whatever we deposit at 2 and 3 times what we deposit for long-term care. But here's the other one, okay? The wheelbarrow on I-44 method. This came to me from a long time ago from a lady that lived down by Stod City, and she may be listening today. And if she is, God love you, right? You're a good gal. I know that you were only taking Bob's recommendation.
Yeah.
But basically she said, yep, he told me that if that day comes, just to take him out there in the middle of the night in the wheelbarrow and set him out there and let an 18-wheeler run him over. Now, I am not recommending this, Joe.
No, not at all.
But I just thought it was interesting. But that's how, some people, they know it's serious, and it can be serious.
Yeah.
And it's a conversation we have to have with everybody as to how they want to approach and potentially tackle this beast. Is there any correct, right, wrong answer? We didn't talk about Medicaid. Medicaid is one of the things that we have helped people with for many, many years to qualify and maybe protect a family farm or protect their home or protect some of their inheritance for their kids. Depending on what assets they own and how they're held determines a lot of what we can do to help protect those things. But there are good answers out there, and they don't always include insurance. I want people to know that.
All right. So the ways to pay for long-term care used to be 4. We're going to include this last one, number 5. First one's out of the hip pocket, but $6 to $8 grand a month for assisted living, and then 7 to 9 for full-blown care. Most people are not plumbed to do that. Aid in attendance if you are a veteran. Check into that. There's also long-term care insurance, which as you get older, when you need it, it just doesn't become financially feasible. Also, you can self-fund long-term care. And, of course, the wheelbarrow and I-44 method, which is not what we would recommend, but it was a funny thing to talk about. So some people are misunderstood that Medicare is going to pay for long-term care, but it just doesn't do it, does it?
No, potentially up to 100 days. And many of the Advantage plans today, you're going to run out of benefit at 20 days. And, you need to be in a rehabilitative state to even get that to happen. The moment you quit improving is when the insurance company has the right and will probably say, we're going to have to take you off the benefit.
All right. And you piqued my interest a little bit earlier when you said saving the family farm, and I want to reiterate that. There is a method by which you can save the family farm from the nursing home. Is there a way that you can explain it to us in simplistic terms?
Sure. Basically, Medicaid rules say that if we transfer assets 5 years ahead of time into a trust, or for that matter, you can transfer it to anyone, but I would say let's put it in trust. You know what they say? Put not your trust in money, but always put your money in trust, right?
I like
so
it.
Basically, what it amounts to is if we set up a properly structured trust and we transfer assets 5 years ahead of time, that asset is held harmless against Medicaid attaching a lien if they pay benefits for you after you pass away.
That brings us to our last question that we want to talk about on today's program, Randy, and that is going to be estate planning. Does everybody need to plan for an estate, or does everybody even have an estate? I know people who say, well, I don't have anything. I don't have an estate. I'm not going to worry about it.
Yeah, so everybody has an estate. They're just like people. They come in all different shapes and sizes, right? So it's one of those things that everybody has an estate and they need an estate plan. So an estate plan basically is, how do I want things to go when I'm no longer here and I can no longer help it and control it? Maybe I'm incapacitated, or maybe I have passed away. How does that stuff go? Also, with part of the incapacity goes back to Medicaid and structuring assets in such a way where you can maybe qualify for VA benefits and Medicaid and thereby preserve assets for either your spouse or for your beneficiaries. So the estate plan basically many times is made up of a trust. It's made up of powers of attorney for healthcare, for finance, a will, a living will. All those things are part of an estate plan. And I would just encourage people to sit down with an attorney, an elder law attorney, or somebody that's really well versed in doing estate planning. We have Elizabeth Floyd of the Floyd Law Group that can help with that and does on a daily basis. That's really what she is about, is estate planning and asset protection. She is able to kind of walk people through what that process looks like. And everybody's situation is different. So there's no just one size, one blanket, that fits everybody. Everybody's family dynamics are different. Everybody's goals and dreams and wishes are different for their estate. So I would just encourage people to give a phone call to the Floyd Law Group if they want to talk to Elizabeth or anybody else that can help that they run into out there. I mean, we don't have a corner on estate planning here, but Floyd Law Group is a good place to go. And Elizabeth has many years experience working under many estate planning attorneys, as well as herself being an attorney and doing that full time now.
Let's talk about wills, Randy. I have just discovered that more than half of the people age 55 plus do not have a will. When is a will just simply good enough and you don't need a trust, or do you always need a trust?
Well, again, in today's world, we know that, somewhere between 45 and 50% of all marriages end in divorce. Well, I don't know how many of those people have kids and things, but and how many go on to get married again and have more kids. But certainly if you've done that, you are going to potentially have an issue when you pass away and you try to pass things to your kids. Or if one spouse dies ahead of the other one and we have yours, mine, and ours, that creates problems. The will is basically instructions to the probate court as to how things are to go. So if that's all you have, you will end up in probate. Now, you can assign beneficiary designations to your IRAs, your 401ks, to your life insurance and that sort of thing, and that does bypass probate. In the state of Missouri, we can use beneficiary deeds on homes and things like that to avoid probate, but it doesn't give you the ultimate protection against maybe, again, your house being seized by Medicare or being there holding their hand out as soon as your house is sold after you've passed away if you've gotten benefits from Medicaid. There's just a number of things that come into play. The best thing that you could do is sit down with someone that does estate planning and let them assess your situation. You're going to know after they've talked to you what you really want to do and what you're probably going to need, and then it'll be up to you to pull the trigger to do, what you want.
And there's this website, it's called caring.com. I just looked it up while you were talking, Randy, and it concluded that 32% of Americans have a last will and testament. So fully around 2 out of 3 people do not even have a will. But again, we're lucky here at Floyd Financial Group because we have Elizabeth Floyd here, the Floyd Law Group, who certainly does specialize in estate planning. And if you have questions about anything that we've talked about today, including in estate planning, we invite you to give us a call here at Floyd Financial Group. Our telephone number, 417-889-7233. Set up an appointment with Randy or Jake or maybe even Elizabeth here to talk about your individual situation. We can talk about pretty much everything. On today's program, we've been talking about these questions here, which have included Social Security, when to take it, pension versus a lump sum, when one is desirable over another, also how much income you need in retirement, how long that income is going to last. We talked about taxes, investments, Medicare versus Medicaid. We've talked about Roths, long-term care, and estate planning. Boy, I'm surprised, guys, we got this in an hour. There's so much to talk about here. But anyway, if any of this conversation has piqued your interest, you'd like to get in and sit down with Randy and Jake, again, call that number, 417-889-7233. Set up this no-cost, no-obligation, no-judgment conversation. Just leave your name, telephone number. Ashley will give you a call back during the week and get that conversation started. You can also find out more about us online at floydfinancialgroup.com. Well, gentlemen, we just get started, and then we're out of time. I want to thank you for your time, but most importantly, I want to thank our fine listeners here in the last bastion of sanity, Springfield, Missouri, for joining us. So for Randy and Jake, I'm Jeff Shade. Have yourself a great weekend and a great St. Patrick's Day on Monday. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF. where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.